Okay, all right, we're good to go. So, just another welcome to everyone that's taken time out of their busy days to join us for this start of our webinar series, a spotlight webinar series that we've begun. This is the first of many that will come, in which we'll be working with our key experts across the RSM, ESG, and climate services team to bring you some information around this, this fast evolving space of ESG and climate reporting. But to begin with, we are going to focus on the specifics around the mandatory climate risk reporting that's coming in. But first of all, I'd just like to introduce myself and my colleagues who will be joining. We'll be dividing this session up. We'll probably speak for around 45 minutes. We've allocated around 15 minutes for some Q&A, so please do take advantage of the opportunity to put a question in the chat. We'll either try and address them as we go through, either through just typing a response, or we'll answer it live. Anything that we can't get to, we will be taking note of those questions and compiling some kind of response to that. So please don't be shy. Do respond to the questions or add your questions as such. But first of all, just like to introduce my colleagues, starting with Linda Romanovska, who is our partner in our Sydney, Melbourne office. Linda is a seasoned specialist in sustainability strategies and reporting, sustainable finance, and natural capital, and has been appointed as a member of a number of high-level advisory bodies focusing on sustainable finance and corporate sustainability reporting frameworks and standards at the national and international levels. Just skip over just to that. She has over 15 years of experience and specialises in ensuring compliance with sustainability disclosures across the globe. A fun fact about Linda is that she can recite 50 sustainability-related acronyms in under a minute. Sorry to bring that up, Linda, but and I won't put you on the spot now to actually do it, but thought that's quite cool. Well done. Next, we've got Jacob, who's got over 18 years experience working across risk, ESG and internal audit services. Jacob has been assisting clients in the energy and resources industry, transport, infrastructure and the public sector. Jacob works closely with senior management and regularly presents to boards and audit committees. Jacob is our global ESG chair and is a Category 2 greenhouse and energy auditor. I myself, I've got a background in economics with experience in business, economics and finance across government and private sector in Europe, Asia and Australia. More recently, I've spent the last 6 years developing sustainability programs and services to help organisations as yourselves jumpstart and integrate sustainability within business. So there are our contact details, obviously, depending upon where you are in the country. If you do need to reach out to us, please do. So to get things moving, I'm going to hold on to the microphone for the moment, but essentially our agenda is as follows. We'll just touch on some research that we did late last year around understanding how ready is corporate Australia for these mandatory climate risk reporting requirements. We'll then just go into the fast facts around what is it, what's happening, who's included, when is it happening. Very important is really understanding the global context in which this is happening. This is not obviously happening in isolation. This is absolutely global movement of which companies really need to understand what's going on there to be able to develop a strategy around sustainability and climate risk. Then we'll go into sort of unpacking what are the reporting requirements. This has been sort of an area that's probably been neglected up until now. We really want to get into this a little bit more and also help our clients understand what is good reporting, what does it look like? And we will be holding a subsequent session in a few weeks' time, which will be focused purely on climate risk and helping companies actually understand how you determine that. Then we want to sort of okay, well, practically, where do you start? And understanding that climate doesn't happen in isolation. It is actually part of a broader bigger picture strategic issue that needs to be considered more holistically as part of your business. And then hopefully we'll have some time, obviously, to take some questions as well. So, but as mentioned, please just start plugging those questions into the chat as we go, and we'll do our best to actually address them. So we scraped the data of 1,500 companies, private and public, basically looking for data around whether they were disclosing information, whether they had a sustainability report, whether they disclosed information on scope 1 and 2, whether they had any targets, if they'd done climate scenario analysis, and just broadly speaking, just sort of kind of honing in on those issues to give us a bit of a sense of how ready we were. The statistics weren't all that positive. It did suggest that there is much work to be done in terms of actually getting to the point in which you can disclose on climate risk. As many of you probably know, one of the mandatory reporting metrics are your emissions, scope 1 and 2, and as you can see that we've still got 30% of Group 1 companies, and I'll get to that in a moment. What does a Group 1 versus a 2 or a 3 reporter mean? But 64% of mandatory reporters currently don't publish a sustainability report. So these sort of statistics do indicate to us that companies have a lot of work to do between now and when they need to report. We did sort of look at industries and sort of carved up the data and sort of did come to the conclusion that those that were leading were mining, financial services, the energy sector and real estate. Laggard industries were construction, retail, ag, forestry, fishing. And this is again, when we say leading versus laggard, we're specifically talking about this, the specific data that we were looking to scrape across the market. So interesting information to have. The plan is for us to actually go back to this data year on year and get some sense of how industries and companies have actually progressed on this journey. So just to now just kind of go over what the Australian requirements look like. I've just put here on a slide to really kind of, I know there's many people who have attended sessions like this before, probably have a good understanding of when this is coming in. It did get delayed. It was intended for only a few weeks from now to begin, 1st of July 2024, but this got pushed back and it is now 1 January 2025 when it will come into, when it will be phased in. It's still yet to go through the final step of Parliament, but the expectation is that it will go. Australia is leading with climate first. However, this is not at the expense of all other issues, all the more broader sustainability topics, but the emphasis and the focus to start sustainability reporting under the new framework, Australian Sustainability Reporting Standards, ASRS, just to add to the alphabet soup, will be climate risk first. But the framework has been developed and designed to be scaled and flexible to include other ESG and nature-related risks disclosures. So it is just the beginning. And the idea is that this framework will be scaled and flexible for companies to either disclose voluntary in the first instance, or as the legislation starts demanding further disclosures, there will be a framework in which to do so. Disclosures to be part of entities' general purpose financial reports. The adoption of sustainability reporting is to mimic financial reporting, so principles of financial reporting such as clear, concise, effective reporting, fair representation, all information should be based on reasonable basis. It all applies. As is the alignment of reporting should be in line with your financial reporting period. So if you're a calendar year reporter, calendar year, financial year reporter, financial year. Scope 1 and 2, as previously mentioned, will be in year 1. Scope 3 will be in year 2. We all understand that's going to be extremely difficult and challenging. We'll touch on that a bit later in the presentation, but it is the expectation that companies really do understand their value chain emissions. Scenario analysis is part of the requirements. At least two possible futures is at the moment asked for. A 1.5 degree world in line with Paris Agreement is one of the ones that they want to benchmark. And so then you get to choose your second, possible third future in terms of understanding what is the future possibilities of your business under these climate scenarios that you can choose and which you will disclose against. Modified liability, there is a transitional period of around 3 years that's expected. This is to account for the fact that this is greenfields reporting. Lots of the data will be potentially not robust. So it's giving companies some time to actually get this information, processes, procedures, controls, governance in place to ensure that better reporting will happen in the near future. But it's still not a lot of time given how much information does need to be collected. So in terms of the phase-in, companies really need to understand whether they are a Group 1, Group 2, Group 3 reporter. To understand this, companies will need to know whether they trigger two of the three elements, being employees, gross assets, or annual revenue. If you trip two out of those three, that will determine when you need to report. Very to understand is that assurance or auditing of this information will be a requirement. This is currently in consultation with the AUASB, and that is going to be quickly phased in, understanding that any disclosures around sustainability reporting will require auditing to ensure that the investors and those reading of this information do have confidence over what is being disclosed. So we have a bit of a roadmap there in terms of understanding when companies really need to report, when the expectations around for Group 1 reporters, it'll be reasonable assurance over Scope 1 and 2 in FY26, limited assurance over governance and strategy, reasonable assurance over risk assessment, and transition plans, limited assurance. This is currently still pending final adoption, as the slide indicates, but ultimately this will be ready to be going into action as of next year. So, understanding that all work done within climate risk really should have that. You should have the fact that it needs to be audited into in the back of your mind. For companies like us that will be asking lots of questions around how did you reach this particular conclusion. We will be looking at effectiveness, appropriateness of methodologies, use of expertise, etc., in determining whether the approach has been fit for purpose. Okay, so reporting is under 4 pillars. This will be the case going forward for not just climate risk, but will be for ESG, nature as well. So understanding that for any of the topics that are determined material, there needs to be some disclosures around the governance, strategy, risk management approach, what metrics and targets have been selected to track and measure performance per se. This is the same. This is what it will be for climate, and we'll get into this a little bit more in the next session. I just wanted to kind of conclude my little bit just to say that there's building blocks in this. It's very important that companies think about a pragmatic approach to building the sustainability and climate strategy and components within your business, because ultimately, if you do it in a haphazard way, it will be disjointed, and you won't have this holistic and the synergies that can be created if you do approach this in a pragmatic way and start with those very important building blocks being your ESG baseline, informed by a robust materiality process. The same goes for climate risk as well. And then all the strategic programs that you have in place to support that, and then the metrics and targets in which you will then manage, monitor, and performance, and then disclose and communicate with your various stakeholders. So it's very important that you build this for your business and understand exactly how things interact with each other to ensure that you're not doing things in an efficient way. Okay. I think it's time for me to pass over to my colleague, Linda. So thank you very much, and I'll come back in a little bit later. Over to you, Linda.
Thank you, Catherine. Someone could please switch on my video. I'm not able to do it myself, so thank you for doing that. What I'm going to be talking about now in the international context is something that will be very, very important for every company that operates internationally. And as we know, businesses nowadays, majority of businesses would be operating internationally, either because you have established representations in other countries, in other markets, in other jurisdictions, or because you are your suppliers are somewhere abroad, or you are fundraising and you have investors from other jurisdictions, or you have securities listed in external markets. So there's so many different factors that determine your exposure to other jurisdictions and what they are doing about their sustainability reporting and regulation. And in many of these cases, either you will be in mandatory scope of reporting based on those other regulations in other markets, or your counterparties, your stakeholders in your value chain will be in scope and will be expecting certain information from you to fulfill their own reporting obligations. And therefore, whenever we think about sustainability reporting and preparing for it, we should not only look at what is being mandated in Australia, we also have to look at everything else what's being mandated in every other market to which you have exposures. And it can get quite complex, especially if your operations are quite complex. You're present in many different countries, you have counterparties in many countries. So this is really important to keep in mind, that we can't really just be operating in this narrow geographic scope here in Australia in this sense. So what is happening around the world? If Australia took the international standard, the ISSB, international IFRS S1 and S2, adapted, changed it, modified it, and is now adopting it as an Australian standard, that's exactly the same process that's happening in many other countries around the world. So we did have the completion of the ISSB international standard late last year. Since then, a number of countries have announced that they are now deliberating the adoption of that standard in their national regulation in one way or another. On the slide, you can see we are tracking 17 plus 1, so plus Australia, countries currently that have made announcements on this, on their pathway. And only a few of them are adopting the international standard as is, right? For example, I know Costa Rica is adopting in full. Most countries are doing the same thing that Australia did. They're taking the standard, they're changing, they're taking things out, they're adding things in, they're changing, modifying. What does that mean? That if you operate in several of these markets, you will have to comply with slightly different rules in each one of them. And they can be, and so you have to be aware of what the similarities are and what the differences are, because sometimes you can't even reuse the same calculations for your scope emissions in two different jurisdictions because they mandate slightly different methodologies that would apply. And that could be case for Australia and other markets because Australia is aligning with the NGES regulations. So the methodology is somewhat different than what other jurisdiction could be mandating. So this is really important. Now, if you go to the next slide, there's a group of other countries who do not really care about the international ISSB standard. They are doing their own thing, right? Why do they do that? Well, most of these countries had mandatory reporting requirements adopted already before the finalization of the international standard. So they were moving ahead. And one of the big ones, of course, is the European Union with their CSRD, Corporate Sustainability Reporting Directive, that has a big standard that is a group of 12 standards, covers 10 sustainability topics. Right now in Australia, we're only mandating 2 climate-related topics, which is mitigation and adaptation. In Europe, it's already a law and mandatory, and the reporting has started, and most companies will be reporting next year on 10 sustainability topics that cover both E, S, and G areas of sustainability. And similarly with New Zealand, of course, New Zealand moved faster and aligned their mandatory reporting requirements with TCFD. They're now looking into, what does it mean and how does that align with ISSB? So far, they haven't announced formal adoption of ISSB because what they already mandate is close enough, right? And so there are a number of other countries that have gone their way. US is really interesting. You may have heard of the SEC rules, Securities and Exchange Commission rules for listed companies that were hugely delayed, and they were also around reporting on climate risks, hugely delayed. Then came and were issued in a significantly watered down version, excluding all Scope 3 requirements and so on. However, were challenged in court within 2 days. So completely unclear what the future of the SEC rules will be. However, California stands out in US and have moved faster by themselves and are mandating both adaptation and mitigation related disclosures. So again, if you operate also in these markets or any of these markets, especially Europe, are some of the most demanding ones. If you have any exposures to Europe, either your investors are from Europe, you're exporting to Europe, you have securities or bonds listed in European markets, or you have significant turnover in Europe, or somewhere in the value chains of European companies, you will very likely be either faced with mandatory reporting requirements from Europe, or you will be asked for lots of information on a range of sustainability topics. So this is really important to remember. Again, keep in your mind, if you're operating internationally, you have to be mapping all your requirements across all jurisdictions. We go to the next slide, please. So I would like to also briefly mention the CBAM, Carbon Border Adjustment Mechanism, and this is specifically talking about the European CBAM, as that's the one that's currently adopted. However, there are similar developments happening elsewhere in other jurisdictions as well. For example, UK is also currently consulting on their own CBAM, and there have been some noises made by other countries, including China, on potentially introducing similar mechanisms. So what is a CBAM? Essentially, it is a carbon levy that you pay on your exports into Europe, in this case, in European Union. If there has been no carbon price or no payment for carbon abatement happening in the country of production of certain goods, which are considered high emission goods, then upon import into European Union, you will need to be paying a carbon levy. It currently covers 6 sectors. Why these sectors? Because these are the sectors that are currently included in the ETS, European Emissions Trading System. And because this emissions trading system is also expanding over time, there will be additional sectors included over time as well. So what is currently happening? CBAM is already in force. First reporting under CBAM started late last year. So if you are exporting any of these goods into European Union, you should already be reporting against CBAM requirements. Currently, it is in a transition period. So currently, you only need to be reporting, but you do not yet need to buy the certificate. So you don't need to pay the carbon price on the border. You will be obliged to do so from 2026. However, do be aware that the reporting requirements are already in place. Next slide, please. This is an example that I usually play through, illustrating on how do reporting requirements look like if you're an internationally operating company. And this is an example of a company that is headquartered in EU, really large headquarters, large company in EU, and has a subsidiary in Australia, smaller subsidiary. However, they are producing a high emissions good, which is steel in this case, and they have a high emitting facility that breached the NDER's reporting requirements last year. And it also exports that steel to EU. So when we start looking at the timeline of how that looks like, on the bottom, you can see that this company would need to be reporting in Australia against the modern slavery and gender pay gap reporting requirements. And it already has to report against the CBAM because it's exporting high emissions goods to Australia, to Europe, which is steel. Now, what happens from next year? They have to do the NDER's registration and reporting from the year after because they have a high emitting facility. From year thereafter, from 2025, they have to report against CSRD, so the Corporate Sustainability Reporting Directive in Europe, which, as I said, covers 10 sustainability topics. They also have to start reporting against the Australian requirements in 2027. Why 2027? Because they would be Group 2 reporters with the parameters that we have listed on the slide. And in addition to that, because they're exposed to European market, there's a whole range of other regulations, which we cannot even mention in this presentation because the list would be really long. that they are exposed to, such as gender pay gap reporting, women on boards reporting, green claims directives, anti-greenwashing directives, and very recently also adopted the CSDDD, which is the Corporate Sustainability Due Diligence Directive, which obliges companies to do due diligence in terms of human rights and environmental impacts in their whole value chain. So this is how the tsunami of reporting requirements looks like for an internationally operating company. And this is only accounting for Australian and EU requirements. So for example, if they're registered in an EU member state, let's say Germany will have additional requirements. Every other market where they operate as well will likely have or may have, again, additional requirements. So this is something that a lot of companies are not aware of, right? They are currently in 2023. They maybe have a few requirements. They are not aware that within 5 years, you will have to be reporting against a dozen or more regulations internationally. So I hope this illustration brings it home a little bit in terms of how important it is to look internationally when we talk about these obligations. I think I end here on the international context, and I will be moving forward into the next session. I'll keep the microphone for a little bit. In this section, we want to go through in a little bit more detail through the 4 pillars of reporting of the ASRS, the Australian reporting requirements, climate-related financial reporting requirements. You may recall there are 4 pillars. First one of them is governance. So what does the governance pillar require us to be reporting on? And the way I structure it in my head, really, governance pillar is 2-sided, maybe not exactly how it's illustrated on the slide, but that's how I like to talk about it. It concerns everything that is on the highest governance level, meaning on the company board. So is there anyone on the company board that has been tasked with overseeing climate-related opportunities, risks, and disclosures? Is there skills present on the board? Is there an individual or a committee that's been tasked with the governance over this topic? How often does board receive information on companies' performance on climate-related matters or exposure to climate change risks? How does the board take that into account in their decision-making processes? So everything around the board. There's also the second part is the role of the management. So how does management and what are their role in integrating climate change into decision-making, into enterprise risk management frameworks, etc. So governance really is about what is your setup? How do you manage this topic? What is the governance over it? What are the processes, procedures, reporting requirements, frequency of that, and monitoring of your developments? Why this is important, right? These requirements actually bring significant liabilities for board directors. Board directors, as part of this reporting, will have to make a statement, write a statement, and sign a statement that all these disclosures, climate-related financial disclosures, are prepared in accordance with the new Act and the related standards. So they do bear the liability. And the liability regime does use the current liability regime for financial reporting. It does go up to jail terms. So this is something that boards absolutely should be paying attention to because the liability really is on board directors. And what happens really is that there's additional risk, and that's on the slide as well, that you are exposed to litigation here. The moment you report something, you want to make sure that this is robust and you have had proper governance over it, because Australia is one of the countries where we are seeing that some of the highest numbers of litigation on climate change, for example. Next slide, please. Right, so the next pillar is strategy, and this is a really dense and very heavy pillar in terms of reporting, probably one of the biggest pillars, because it is divided in 5 sub-pillars and subtopics that need to be reported under strategy. The first one is climate-related risks and opportunities. So in this pillar, we report the results of your climate change risk assessment and how the risks that you have identified, both physical and transition risks, are affecting the company and its strategy and its business plan. So we are not doing the methodology here. Methodology comes in another pillar, but we are talking about the outcomes and the impacts on the business model and the value chain. So the second sub-pillar here is the business model and value chain. So how do these risks affect certain aspects? And you can consider, okay, your products, your supply chain or your value chain, so both upstream and downstream value chain, your investment activities, operations, any sort of larger business strategies such as acquisitions, divestments, access to capital. So what would be the impact? You also need to report on decision making. So once you know the risks, how do you integrate that into day-to-day decision making in the company, and what are the processes that are set up for that? And finally, you have to also report on what is the financial impact of these risks. Now, remember that the name of the requirement is climate-related financial disclosures. And that word financial is really important because it also determines of who the main user of this information is. And the user of this information is the same user as for your financial reporting. And that's assumed that is someone with financial interest in the company. Typically, that will be shareholder or investor or any type of entity that has financial interest. And so their main interest area is, does this impact company's financial prospects? And that what we mean by that is company's value, company's access to capital, cost of capital, overall performance, revenue, etc. Now, there very often is a question, does it have to be quantified? And ideally, yes, it should be quantified. However, the standards currently have flexibility and do say that your financial impacts can be reported qualitatively if, for example, doing quantification would be misleading because your data are not precise enough, and if you can justify that, you opt for more qualitative reporting simply because otherwise the numbers could not really be trusted. And at the end of the day, you have to also talk about climate resilience. So are you prepared to face these climate change risks? Do you have adaptive capacity? How low or high is your vulnerability to these risks? What are you doing about those risks? How do you plan to address them? What strategies do you have in place? And also, how will you fund any plans that you have in place, for example, for increasing your resilience against climate change risks? Next slide, please. This is the next pillar. So I will be handing it over to Jacob. You will see how the risk pillar and the strategy pillar are actually closely intertwined, and I'm giving it over to Jacob to explain that.
Linda makes a great point. A lot of these pillars are interlinked, and probably not good to look at in isolation. But essentially, what I'll talk to in these slides is around what are your disclosure requirements around climate-related risk identification, evaluation, and then the strategies in place after you identify those risks are disclosed in that strategy pillar. So climate-related risks, risk management, if you have good governance processes, you'd be familiar to what risk management is in terms of identification and assessment of risk. But the specific requirement here is identifying what climate-related risks can have a financial impact on the business over the short term, the medium term, and the long term. And what you're required to disclose is the process of how you identify those risks and how you've evaluated those risks across each of those time horizons. And also, there is going to be a requirement to audit that process. So in terms of audit information, you'll need documentation around how you've identified, and as you may have already conducted risk workshops before, facilitation and presentation and slide decks and things like that are some of the information that auditors will be looking to see to ensure that that process that you disclose has actually been completed. I think the other point to note is it's the disclosure requirements around how you monitor and report on these risks throughout the reporting period. So you really need to go through this identification process before your reporting period starts. So as Catherine mentioned earlier with those timelines, you need to have this process complete, ideally before you commence your reporting year. In terms of what we got on screen, everyone's familiar with in terms of hazards, but essentially there's acute climate-related risks, acute physical risks and chronic physical risks, and then there's a transition risk, which I think I'll talk to in the next slide. But ultimately, that determines the actual impact to the organisation. So if we go to the next slide. So as I mentioned, so the categories of risk are divided into two in terms of what you need to disclose. And there's transition risk, which is quite a bit more trickier than physical risk. Physical risk, I'm sure organizations that are in the heavy infrastructure space or with complex value chains are managing physical risks such as extreme weather events and things like that on a daily basis. The main thing is there needs to be a formal approach applied, and you need to look at those time horizons, and I'll speak to scenario analysis in the next slide. So the transition risk is a bit more complex because you need to assess the impact of the future changes in policy and legislative requirements, the risk of emergent technology that may impact your organization, such as green tech that may impact your product or service. The market, so consumer behavior, what's the impact in that transition to net zero and your product or service. Again, you're looking at short, medium, and long term. So long term can be as far as 2050, 2090. So it's about assessing whether that's going to be material for your organization as you continue that on your own strategy. And then the reputation side as well, in terms of increased negative concerns or feedback. These are sort of the things that we would recommend to do in your risk workshop, and then ultimately assess the financial impact on your organization and then it translates down into your income statement, your cash flow, your balance sheet. So these are the considerations that essentially you'll need to go through. Every organization, regardless of group, will have to go through this exercise, and it will have to be documented and it will have to be disclosed. So that's essentially the qualitative disclosures under the risk pillar. I think the other important thing to note is going through this exercise can identify what opportunities exist. So linking it with your strategic planning process is ideal, and potentially that there are some opportunities that organizations can capitalize on by adopting some of the going through this process early and capitalizing on those opportunities. So if we go to the next slide, I'll talk more about the scenario. So this is just an example of some of the physical risks: acute weather, so flood, cyclone, droughts; chronic weather, that's more the longer term, rise in sea level, and if your organization does, if your employees are required to work outdoors, what's the impact of constant increasing heat temperatures. And then if we go to transition risks, I also mentioned those. So they're all of the hazards, and then looking at that facility, looking at that exposure across the facility and corporate, and then also understanding what's the vulnerability, and that should help identify the material risks and also the opportunities. But again, I emphasize you're looking at it for a longer time frame, and there's disclosure requirements on each of those time horizons. If we go to the next slide, so in order to evaluate climate-related risks, there is a requirement under the Australian Sustainability Reporting Standards to conduct scenario analysis. This is also consistent with some of the global frameworks that Linda mentioned, and also consistent with the TCFD, which has been around since 2015. There is a transitional provision to apply qualitative scenario analysis in the first 3 years, but eventually that'll get to quantitative. So in terms of scenarios, there is going to need to be disclosure around which scenarios you choose, and there are global scenarios through the IPCC, and basically stepping through the process of assessing each of the identified risks with different scenarios to appropriately evaluate and also disclose that process. So similarly to the risk management, you will need to disclose the scenarios and your approach and justification, but also justification on risks that aren't deemed to be material as well. And then that'll all need to go through an audit process. In terms of assessing materiality, you've got some metrics there around earnings, impact on earnings, cost, revenues, assets. Again, things that businesses would do if they already have a sort of a mature risk management or enterprise risk management framework, but it just needs to be expanded because these are probably more strategic in nature and require everyone in terms of the executive and senior leadership around the table to go through that exercise. All of these disclosures will be within the general purpose financial reports and essentially should inform some sort of a strategy and should inform disclosures around strategies, which Linda spoke about in sort of that strategy pillar. So if we go to the next slide, I think the important thing to note with risk is it's qualitative disclosures for those, if we go back to, so it's qualitative disclosures, but essentially there needs to be documentation so that there's traceability and it's auditable. In terms of the last pillar, which is metrics and targets, this is where a lot of the quantitative disclosures come into play. Just quickly, everyone should be aware of Scope 1 and Scope 2 greenhouse gas emissions. That's required to be disclosed for the reporting period. Scope 3 I'll speak to in a bit more detail because there are quite a few challenges related to Scope 3 greenhouse gas emissions, and also as Linda mentioned, in terms of the risk, the material risks and climate related risks, and also an internal carbon price. So these are all per the Australian sustainability reporting standards that are still going through consultation, but consistent with other global frameworks, consistent with the global reporting initiative that has been around for quite some time. And then the additional requirement is around targets. So once you've developed these strategies, what are your targets in place to measure the performance, and then the ongoing reporting requirement on performance and the accuracy of how you're performing. So a lot of the disclosure is around transparency, but there is that because it's going to go to your key stakeholders, then you got that sort of that reputational impact if you're not performing well for whatever targets you do set. If we talk to the next slide, which is Scope 3, because we just want to leave some time for questions, but so the starting point is essentially doing a carbon footprint or determining what your greenhouse gas emissions are, Scope 1, Scope 2 and Scope 3. So going through the risk workshop, through the identification of your climate related risks, and also doing a bit of a baseline of what your greenhouse gas emissions are is sort of the first step that we would recommend to undertake. And I guess it's important to discuss some of the lead times for this process. Doing a greenhouse gas emissions inventory assessment, so your Scope 1 and Scope 2 can take 6 to 12 months, and then Scope 3 can take 12 to 24 months sometimes. And there was a question specifically on data that you're relying on from third parties. For some of this information, for some of the data that you need, you will need to get it from your suppliers and things like that. So it's important to understand that lead time as you prepare for the mandatory climate disclosure requirements. And if we go to the next slide, challenges with Scope 3. So Scope 3 relates to your emissions that are indirect, so it's emissions from your suppliers, and it's really their Scope 1 and Scope 1 emissions. So and a lot of the Group 1 reporters are going to be going through this, well, if not already, going through the calculation of the Scope 3 process. So they're going to be going to the value chain and identifying where what are the data requirements, and potentially if you're a Group 2 or a Group 3 reporter, you will still need to provide information if you sit on the value chain of a Group 1 entity, and all of the big four banks are Group 1. So if they are going to be looking at their asset classes and requesting that information. So Scope 3, I won't speak to in too much detail, but it's when we're presented with other institutions, it's a bit of a blind spot in terms of what's involved to calculate this and be ready for the reporting requirements. So if we go to the next slide, and this is sort of the last slide, and then I'll hand over back to Catherine just to talk about where do you start. But this is obtained directly from Treasury, and it basically provides an estimation of costs to accommodate for Group 1, Group 2, in terms of meeting the disclosure requirements under the pending sustainability reporting standards. And it's not essentially external costs that you're going to have to pay, but it just provides a bit of a window into the amount of effort and what's going to be required, and it sort of breaks it down nicely, which is why I like to present this, just to make you all aware. So in terms of education, that's not us presenting to you in a boardroom or webinar. That's training people within the organization, developing learning management modules and things like that. So there's a cost in relation to that. System changes is going to be required. Data collection, as I mentioned earlier, is a key challenge for all organizations beginning this journey. The scenario analysis and scenario modeling is what I spoke to, but just going through the process. And there is going to be a quantitative requirement, so there needs to be some financial modeling in there. Preparation of the climate report, and just going through that process, and then the assurance. So for Group 1 entities, you're looking at a potential cost of $952 million, and then an ongoing cost of 520. That it's not, you don't just divide 952 million by 729, because it's going to vary for different organizations with different sectors based on complexity. But it's just a way to promote awareness of the earlier you start, the earlier you go on this journey, the better it's going to be in terms of to be ready for the mandatory requirements and be proactive. And then there's costs there for Group 2 and so on. So this is straight from Treasury based on one of those documentations. So these aren't our numbers, but it's just a good way just to demonstrate the need for focus and effort to enable readiness for the reporting requirements. So I'll hand over to Catherine now to explain where to start, but also open it up for questions.
Thanks a lot, Jacob, and also Linda as well for taking us through that. I've just paused on that slide too, because one of the questions I do get regularly is around, well, based on, certain organisation sizes, particularly when you're looking, further down to Group 2, Group 3, what is the expected investment in this? And it's very clear in the legislation. It has to be proportionate to the size and risk to the organisation. So it's not the intention that this is supposed to kind of overwhelm your organisation in any way, but there is an expectation that there needs to be investment by businesses to really actually understand that climate risk is going to be a cost to business, primarily from the fact that we're transitioning in a market, and without understanding climate risk and the energy transition and the speed in which this is happening, there is a real risk to your business from a commercial perspective. So there will be investment in time and resources, but it is around business resilience and ensuring that your business understands what's happening around the globe. So we've got 10 minutes to remaining. So if I might just ask Jacob and Linda just to have a squeeze through some of those questions that are there, that and I can just sort of quickly go through sort of coming back to the beginning and where do you start for organisations, and it really is there is a process. And I did catch one of the questions in terms of the amount of details and what actually goes into these disclosures. And a really important point to understand is the disclosures is just the tip of the iceberg. There's work that's required that happens underneath that then results in the disclosures. And to actually do this in a meaningful way, understanding your more broader ESG foundations is probably a great way to start, and that's starting with materiality across the ESG spectrum in your business to really start thinking through, well, what are those issues and impacts around, and the supply chain around what I operate in, the market, the footprint I have internationally, or the industry that I work in. Understanding what are these material issues across the environmental, social, economic pillars is really important to then work into then climate to help inform your climate risks as well, because otherwise you're at risk of sort of shooting in the dark with that one as well. So, and ultimately, whilst the Australian legislation is leading with climate, that's just the legislation, and in Australia we're sort of lagging in that respect. What is actually already out there in front is the banks, your insurance companies asking for this information. These organisations have net zero targets, and they're asking for this information now because they're trying to rebalance their portfolios towards businesses that understand their risks and know that they can be either insured or funded. So it's really important that you understand your stakeholders, understanding that customers and consumer preferences are also changing. New services and products are actually coming to market really fast. We'll have lots of Kodak moments. So it's really important for companies to really be aware of these factors in a what I call a sustainability transformation. So just to sort of move ahead, we do have a sort of a kind of a back of the envelope sort of guide on what does a company need to do to start, and that's really understand, number one, where are you in the value chain? What do you do? What's your business services, products from a macro and a micro landscape? Using that information, you would then do materiality to understand and prioritise those material risks across environmental, social, governance. This would then essentially inform how you need to extract data from your business to be able to report against those that chosen framework based on the material risks that you've selected. And then you do, it's a big data game, ESG and climate. So these, for the most part, haven't existed in a lot of companies. There's a lot of data there that probably also exists that you do need to, that you just haven't actually leveraged in the past. So you really do need to kind of unearth this information in your business, and remembering that this information is valuable information and can help you understand essentially your business in a better way as well. So there is a lot of value in going through the process of understanding what your ESG risks and opportunities in addition to climate risks and opportunities. So it's don't look at it through the lens of just compliance. There is actually a lot of value to be had from actually going through this process. Internal setup, then we go into data collection mode, remembering that this information it's not a one-off, it's year on year. This information, you'll have dynamic information, you'll have static information, but the ability to collect this information and then produce this information on a regular basis for various stakeholders, creating that central source of truth is really important so that you can then use it to compete, whether it's in procurement and tendering processes. It's becoming a business must to understand these aspects of your business. And then building in those disclosures from a financial point of view is obviously the compliance aspect as well. But just to that point, within a company, this can take a long time. So starting at the beginning and getting through can take anywhere between 6 and 24 months, depending upon the complexity of your business. Right. I will stop there and leave it on this very busy slide, which is essentially the sustainability journey. These are all the things that we do, but this is really just to acknowledge the fact that the business parameters have changed and will continue to accelerate as we journey on this energy transition or sustainability transformation. And so it's really important to know, what does this mean for our business or your business? RSM as well has had to do a similar approach. There is no businesses actually that can sidestep sustainability, all this. So whilst I think there was a question of whether there was not-for-profits, I probably wasn't clear. They aren't required to report at the moment in terms of climate risk reporting. So if you're an ACNC registered business, you do not have to report for now. This is very much obviously very live and dynamic, this space. So, but there'll be other sort of drivers that will require you to essentially address a similar process in terms of understanding your ESG risks and opportunities based on your own value chain and industry dynamics. So I might just pause there and ask Jacob, did you grab some questions that we might like to answer? And Linda as well.
Yep. No, thank you all for putting all the questions. We tried to answer a couple as we went through, but just the first one was around greenwashing. I won't read the question in detail, but the gist is obviously there's a risk around greenwashing, and I guess what's our approach in terms of promoting well, whether we're going to be using encryption or through blockchain, or what's our approach to supporting sustainability claims from Australian businesses, and noting that Australian supply chains export to the EU countries. I think I just wanted to make a point on that. Was the first step of this reporting requirement is transparency. There is going to be an assurance requirement, as we mentioned. So through that assurance framework, the integrity of that information should improve and whatnot. So I guess it's just going to take time, and our approach is obviously disclosing what's factually correct, but the assurance framework should be able to clean out the risks around greenwashing as that matures and that process continues. I think there's another question around Scope 3 and clear understanding around compulsory inclusions. You need to go through the value chain mapping exercise. You need to understand what the boundaries of your value chain, and you're going to need to disclose that. So as long as you're transparent in terms of what you disclose to be in your value chain, which then in turn informs your total Scope 3, that's the direction we would recommend. Sorry, Linda, did you want to answer any of the other questions in there?
Yeah, I just have an answer on the state level. What happens with state entities? Because government entities generally will be covered by the very same standards. There is a whole regime that already been announced by the federal government that also in a staged way will apply to federal government entities. However, on the state level, there is currently no full clarity on this. States are currently in a bit of a wait and see process. A couple of states historically have had sustainability-related disclosure or reporting requirements, including Victoria, including New South Wales. And some of those have been paused, especially in New South Wales. They have been paused in expectation for this regulation to be adopted. And so we are waiting for these announcements from the state authorities in terms of whether they will apply the very same regulation that is now currently being adopted for companies, and that also the Commonwealth government is adopting for federal level entities. There's also a question on whether SMEs would be affected by that. And the answer is most likely yes. If you are an SME and you are somewhere in the supply chain, value chain of group 1, 2, 3 reporters or international companies, you will be affected in a way because they will come to you and ask for data. Why? Because you are in their Scope 3 emissions, you are in their value chain climate change risks, meaning that you can expect the moment Group 1 companies will be reporting, and these are some of the largest companies in Australia that have many, many suppliers and business partners, and a lot of those partners will be SMEs. You can expect that they will come to you with certain requests for information. So a good advice for SMEs is also to look into that and be prepared to maintain your competitiveness in the market and attractiveness to these bigger companies to whom you supply. Any other questions, Jacob, that you would like to jump on?
I think we're right on time, but I think the plan, right, Catherine, is for us to collate the answers and send them through anyway. But over to you, Catherine, to close.
Yes, thanks both Jacob and Linda, and everyone else that's been able to join the webinar today. We're right on 12 o'clock. In terms of final remarks, I think most of us, the three of us, probably got the same comment, and that is, you do need to start now. You do need to understand how this is going to impact your business. It will take time. there is help out there to have. Obviously, we do this. This is our bread and butter, both from an advisory point of view, but we also work in assurance, providing, particularly for those organisations looking to do their emissions for the first time. It's also very useful to get sort of audit readiness done early so that you can be comfortable and confident with the approach in which you're going about this. There is a pragmatic and methodologies around how you approach this, and so it's important that you do get it right from the beginning. That will save you time, effort, cost in the long run. So get it right in the beginning, and then you'll be able to build that capacity and capability internally to keep going year on year. I don't have anything else to say. Jacob, Linda, any last comments for you? Otherwise, we'll sign off. All good? Okay, well, thank you again for your time, everyone. Really appreciate it. And we'll be in touch with the next webinar, which will be a few weeks away. So thanks very much.
Thank you all.